So, you own a luxury property in Hawaii. Congratulations, you're living the dream. But you own it through an LLC, and now you want to sell. And your buddy at the golf course, let's call him tax expert Todd, told you a brilliant secret. He said, Jason, just dissolve the LLC before you sell. Turn it back into your personal name. It keeps things simple. Todd is wrong. Todd is going to get you audited. Don't listen to Todd. Hi, I'm Jason Wong, principal broker and founder of Island Dragonfly. I've spent over 22 years navigating luxury real estate market, and today we are doing some entity cleanup. Here is the million-dollar question. If you are a foreign seller, should you dissolve your LLC before or after the sale? The short answer, almost never dissolve before the sale. Here is the deep dive on why, and it gets a little spicy, so pay attention. First off, the IRS is not blind. If you have a single member LLC, the IRS calls this a disregarded entity. That sounds mean, but it just means for tax purposes, the LLC doesn't exist. The IRS looks right through it and sees you. So, if you dissolve the LLC and put the deed in your own name before selling, guess what? You didn't save a penny in taxes. You are still a foreign person under FIRPTA rules. You are still subject to the 15% federal withholding, and you are still subject to the 7.25% HARPTA withholding here in Hawaii. All you did was spend money on legal fees to transfer a title, just to pay the exact same taxes. But wait, it gets worse. By dissolving the LLC before the sale, you just stripped away your liability protection. During a sale, you have open houses, inspections, strangers walking through your property. If someone slips and falls or sues you for a non-disclosure, if you dissolve the LLC, they are suing you personally, your savings, your other assets. Why would you voluntarily throw away your shield right before walking into battle? That's just bad strategy. Now, here's the dangerous part, the corporation trap. If your LLC elected to be taxed as a corporation, or if you have a multi-member partnership and you dissolve it before the sale to distribute the property to yourself, you might have just triggered a taxable event. The IRS often treats that distribution as if you sold the property to yourself at fair market value. You could owe capital gains tax on a property you haven't even sold yet. Imagine writing a check to the IRS for a house you still own. That is the definition of a bad day. So, what is the smart play? Keep the LLC intact. Sell the property inside the LLC. Let the escrow company handle the FIRPTA and HARPTA withholdings because they are going to do it anyway. Once the sale closes, the liability period ends and the cash is in the bank. Then you work with your CPA to dissolve the entity and distribute the cash. It's cleaner, it's safer, and it keeps your liability shield up until the very last second. Disclaimer time, I have an MBA, but I am not your CPA, I am your broker. My job is to get you the highest price and the cleanest terms. Your CPA's job is to file the forms, but you need a broker who understands the difference, so you don't make a mistake before we even list. If you are ready to sell your Hawaii property and you want a strategy that actually works, let's connect, let's get your property sold, and let's keep tax expert Todd out of it. I'm Jason Wong. Aloha.